All right. Hey, everybody. Welcome to the Real Estate Investing War Room Live. I'm here with Randy Langenderfer. Now, Randy is with InvestArk Properties. He is a seasoned general partner in over 1,500 doors, representing an impressive $250 million in assets under management. His strategic investments span across Texas, Oklahoma, Arizona, South Carolina, and Louisiana, totaling 3,000 units, and focus on delivering substantial returns to passive investors while enhancing communities. Randy is a dedicated contributor to national education programs and is a private multifamily coach. He is also a former chief compliance and audit officer for a prominent academic medical institution in Houston with a bachelor's in accounting information systems. He also has an MBA in finance and is a CPA. He is a true powerhouse in both real estate and finance. And we're excited to have you on, Randy. So thanks so much for joining.
Ryan, thanks. Really appreciate the opportunity to be here joining your audience, and let's get at it and have some fun.
Excellent. Well, I've kind of gone a little bit over your background, but, just so everybody tuning in, getting to know you, I'd love for you to kind of tell your story, kind of walk us through your journey of like how you got started and, how everything has progressed to where you are now.
Well, thanks again. It is a pleasure. And for your listening audience who haven't met me or I haven't seen them before, my journey really started back in about, I say the Great Recession, 2008, 2009. And I was working in corporate America, and I was working for a private equity firm. And anybody knows that a large private equity firm doesn't have a long runway. Those jobs aren't meant to be permanent. I knew that when I took it, and I was happy with that. But 2008-9 hit, and I just realized that I really needed to find another source of income, another revenue stream. My ladder was leaning against a corporate wall that was good. I was fairly heavily compensated, but just realized that wasn't going to be forever, and still had a lot of runway left in my life that I thought workroom. So I started exploring, and I started looking for buying small businesses, buying franchises, just anything out there that could extend my work life and get out of the corporate rat race per se. And so about that time, I had a brother-in-law who turned me into a single family we were hard money lenders, just a short story, for a group out of South Florida. And we lent the money to them to go out and make single family house flips. And we did well at that. That was probably the 11-ish period. Fast forward to 2013, that corporate job was definitely winding down, and I needed to find another one. And I landed in Houston, Texas for, as you said, a big academic medical institution here. And at that time, I came down here, and I had a lot of time on my hands. And so I just started attending every real estate meetup group there was in Houston, north, south, east, and west. My family wasn't down here yet. And so I just attended every one and getting indoctrinated into the city. And so I continued with single family hard money lending for a while. And I did several projects here in Houston, but I just came to the conclusion that I was getting frustrated because as we all know, to scale that, it became very difficult, especially with a W-2 job at the time. So I just happened to attend a Lifestyles conference here in Houston, Texas. Lifestyles is a big national education arm. Attended their weekend multifamily and single family, I'll call it educational program. And just really then about a month or two later, I ended up attending the Lifestyles Expo. That's an annual event here in Houston. And I heard then Brad Sumrock, this is back in 13, early 14, speak. And, he had 3 sessions, and I sat in the first one, and I was just mesmerized. So I came back for each session. I sat in all 3 of them, the repetition, just because I'm a slow learner. And talking about multifamily and the differences that multifamily, and going backwards, when I was looking at small businesses, every bank required you to sign a personal note. And I'm not a wealthy man, but I've had savings and stuff that I didn't want to lose. And so that was really the first trigger for me for multifamily, that I can buy a multi-million-dollar asset on a non-recourse loan and not have to sign personally for it is just a beautiful thing, as you know. Mm-hmm. And that was an aha moment for me to get started. And so at that time, I started investing in other people's deals and just became a sponge. of information. Started listening to every podcast I could find, every meetup that was available. I was just networking like a fiend and trying to find and understand this process, and then started to invest in my first one in 2014, the spring of 14. Invested in several others. And that mindset there of mine was I was laying the exit for the corporate in 2023, which was just last spring. I actually stepped aside. So during that whole time period, the whole 9 years, I had a very conscious and a very deliberate plan to educate myself and invest in these things and understand the intricacies of the acquisition and the operations process so that I could one day do it. And eventually in 2018, I formed a co-partnership with three other guys, and we bought a building in Beaumont, Texas. For your audience that's in Texas, everybody probably knows where Beaumont's at. It's about 120 miles east of Houston, but anybody outside of Texas, right on between us and St. Charles in Louisiana. And, it's a heavily blue collar community. It's been plagued with floods several times, but a great working class community. We had, I can go into another whole story there. We had a whole nightmare of operational issues, a myriad of operational issues. I say that I tell people I got my honorary PhD in asset management on that property. But it turned out to be great. We doubled investors' money in less than 2 years, but it was a great learning course. And so I continue to passively invest, and I'm still actively looking for other deals to sponsor today, and looking for investors and marrying those two together. So that's the short story on Randy.
Excellent. No, I love to hear it. You have been in a lot of deals and you have a wide variety of experiences here. So I'm curious if you'd walk us through, what was your mindset as you were transitioning? Obviously, you did the lifestyles course, you'd done some single family, and then your first investment in multifamily, that was a limited partnership. You put your money with some other sponsor, correct?
That's correct.
Yeah, I'm curious, what was your mindset? How did you decide who the sponsor would be? How did you evaluate and underwrite the deal? What did it feel like giving your money to somebody else?
Oh, those are all great questions. I remember vividly because I remember going to the lifestyles event, and I remember asking one of the guys, well, how do you hear about these deals? And well, you can't even hear about the deals and lifestyles unless you're a preferred investor group. At the time, it was called PIG, Preferred Investor Group member, which cost $25,000, $30,000. And then I started to go into the Sumrock audience in Dallas and ask the same question. They said, well, just hang around this audience. You'll find plenty of them to invest in. And so I ended up investing with a guy that was from the Sumrock group at the time, of which I was part of. And I've since gone on to part of Rod's Khalif's group today. But I invested with this guy because he, it's the old illustration that you invest with those you know, like, and trust. And this gentleman was a corporate guy like I was. He had left the corporate world and was doing multifamily. He was a smart guy. I liked him. He pulled down this deal in and the first one was in Port Arthur, Texas. And so for your listening audience, if anybody comes to you with a deal in Port Arthur, turn the other way. But this deal was, it was a 228 building unit that was 3 miles off the Gulf. And the play was it had been actually abandoned, and some developer took it over and rehabbed it. So when we bought it, it was only like 60-70% occupied. And the play was really just to lease it up to 90+%, refinance it, get a bunch of money out, and hold it. And we did that. After about 18 months, he refinanced it, and we got about 60% of our money back. And I was thinking I was a pretty big deal, pretty smart guy.
That's successful, process right there. So that's the way to do it.
Tried and true. But then it followed, and it was, you talk about, first of all, investing in it. I remember vividly, I didn't even invest in it all myself the first time because I was corporate guy with risk mitigation in mind and strategy. So I partnered with a brother-in-law of mine to invest in one of these. And we went halvesies on 25 each for a total of 50. But after 18 months, refinanced it thinking we were pretty good. And then it was plagued with a 5-year run of disasters. So we had a fraud by the property manager committed.
Mm.
Then we had Hurricane Harvey flood that wiped out all the first floor units in Port Arthur. So fraud, flood, and then there was a fire in the building where, three kids, I'm sorry, were actually lost their lives. 3 young children, very tragically.
Mm-hmm.
And sad story, but out there too, you have only in America where a mother left 3 children in an apartment building herself by themselves, left for the night. There was a fire. Regrettably, the kids died very tragically, and she sued us
Mm-hmm.
as the property owners. So fraud, fire, flood, and then then it was COVID. And luckily, we got out of that project 6-7 years later. We got all of our capital back, so I never lost any money, but we didn't make a dime either. But those are Ryan, some of the horror stories. But it's a business, so investors need to be aware that things can happen like that, and have to plan for them and know sponsors and make sure they're competent. Since then, I've invested in probably, 25, 30 different deals. And I'm averaging over those deals, and that's with that one that has a 0 in it. I'm averaging 130% return.
That's incredible.
So that means I've more than doubled my money. 100% is doubling your money plus another 30%. So some have really good returns. That's the worst one I've ever been in. And over the long haul.
And that was your first one? That was the worst one that you were in?
Yeah.
That's a rough start to get into it.
Well, and as you know, it was a rough start, but you don't know about this until after a couple of different ones you've been in. You don't know what a bad one's like until you've been in a couple of good ones. But so been in many of these, both as an LP, as a general partner. I just really think it's a great asset class that more people should be in. I come from a finance background in corporate America, so it's very easy to say, follow the traditional model of stocks and bonds and the asset allocation around that. But there's just a really gem out there that people don't know. The value of investing in commercial real estate, i.e. multifamily, is, favorable tax treatment, positive cash flow, and forced appreciation. So it's something that I think more people should look at. I'm not saying as much of their net worth as mine should be in it, but they should be thinking about it.
Yeah, absolutely. No, I agree with you there. Obviously that's why we do multifamily on our end as well. So, it's interesting. You bring up a good point about the things that can happen when you're doing real estate investing, especially multifamily, because, this is the real estate investing war room where we all know that there are profits to be made. I've made great profits. You've made wonderful profits on it, but there are also a lot of difficulties that come along with investing in these properties. And it is a real business and you're affecting real people's lives. These are their homes. And so you have to take extra care to make sure you're doing everything the right way. And there's just problems that come with working on, where people live. So I appreciate you kind of sharing some of those. I'm curious to know a little bit more of your headspace. And then I'd also be interested to know, for the limited partners who are listening and interested in maybe getting in on one of these deals, but they're hesitant and they know could be risky, but they also hear that it could be very profitable. Talk more about, like, if you are a limited partner coming into these deals, what would you look for to know if it's a good deal or a bad deal? And then what's the roller coaster of you being an operator versus just being a limited partner on some of these and letting somebody else handle all those problems?
So at first, as a limited partner, I would say, and I still am a limited partner, I say it's just like, there's a difference between investing and speculation. Speculation is what I do, and what I call speculation. I put that in my 401k, where I just stick it in a mutual fund, a blend, or an equity or a bond fund or something. You don't know anybody. You just look at the returns. But investing requires some work. So I think the thought of a passive investment is kind of an oxymoron, because it's really not passive. It can be if you really want it to be. I have investors who just do that. They just give me money. But I think as a true investor, you should understand the risk. And so when I tell you how I look at properties, that's about the only thing I can do, is when I look at opportunities that come across my desk, first and foremost, it's the sponsorship group. Do I know them? Period. Do I know of their track record? And what is their history? What is their distribution payouts? Have they had any capital calls? Questions like that. And then secondly, it's it's really around the market. So I tend to focus on the Sun Belt. So I like the Carolinas over through the Arizona area with great operators and great teams of people. So, if somebody sends me an opportunity in Topeka, Kansas, I'm not going to look at it just because it doesn't fit my criteria. So first the horse, that's the sponsorship group, and then the jockey. I'm sorry, the jockey. Excuse me. The jockey is the sponsorship group, and the horse is the submarket, and the horse and the jockey illustration. And then it's just a matter of drilling into the property. What are the assumptions that sponsorship group are making in their underwriting? I'm sure you have too. You've seen some pretty aggressive underwriting and been in this business.
What would you define as aggressive underwriting? If somebody that doesn't know, what do you think is aggressive underwriting? What's a red flag for you?
So for investors, you will never hear, I have never heard an underwriter say, we underwrite very aggressively.
Right.
Nobody does. They all say we underwrite very conservatively, and maybe from their perspective they do, but one person's conservative is another person's aggressive. And to that question, I would say aggressive is one that looking at the rent growth assumptions. If I have 10, 20% rent growth assumptions, I think that's very aggressive.
Right.
And the expense growth assumptions. Another one is the reversion cap rate. That's what you're estimating this is out 5 years from now. It should be probably, depending on where you're at, around where you bought it at or more than, just to be conservative, assuming cap rates go up. And then, the one I hit real hard on is what's the sponsorships group's relationship with the property management company? Is this the first time they've been in Houston, Texas, or the 20th time? And even if they've been in Houston, are they doing, class A properties and we're buying a class C property? Do they have any experience with the specific submarket that we're buying in? Because they're the ones that are really going to make or break the deal for us. The property management company. So those are just some of the things off the top of my head that I look for as a limited partner.
Yeah.
And I'm sure if I thought about it, I could come up with some more, but those are top of mind big ones.
Well, hey, we got a little shout out from John. He says, "What's up, Randy? Appreciate you tuning in, John."
Hey, John.
Yeah.
Good to see you. Thanks for joining.
So I'm curious, as you're talking about this, obviously you raise capital from investors as well on deals that you're a general partner on. Investor sentiment has changed a lot from last year to this year, and so I'm curious, what are some of the feedback that you're getting from other investors in the marketplace? How have things shifted, and what are some of the questions people are asking as we go into 24?
I think limited partners and investors are really trying to gain confidence that we know what we're talking about, and that we have some experience to share in the asset management sides or in deals and underwriting and stuff like that. So I spend a lot of time these days talking to investors and building the investor database. So I spend a lot of time there doing that. And I think, just as you said, they're skittish. They see the nightly news or read the newspapers and they hear about interest rates going up and trying to understand how that's going to affect their investment. And there's pluses and minuses of an inflationary environment. Generally, asset prices are going to come back up. They're not going to be down forever. And, where you buy in the cycle is important. So I think also that I would subscribe to the theory that, you buy in all markets, up, down, and sideways. It's just that you buy very differently. If you bought in 2021 or 22, you most likely bought the deal on variable rate debt. Well, in 24, I wouldn't touch a deal on variable rate debt anymore. It's going to have to be fixed rate capital. So there's just different ways to look at it. And you have to really gauge what's the investors, the LP's appetite for risk. I've told several people, this isn't for you. After you talk to them and kind of share their story, and the worst thing you want to do is take the last $50,000 of somebody that they got for a spendable income. So no, don't do that. And if this is a very illiquid investment, so you're going to be in it for 5 to 7 years, plan on it. You can't trade that. You can't trade your investment like you would a mutual fund. So you just have to really know your investors and understand them. But there are plenty of people out there, and there's a ton of money on the sidelines waiting for a nice deal and the confidence.
Mm-hmm.
There is a ton of money on the sidelines. People just waiting to find deals that they think are respectable and got a lot of upside in them. So I don't think the capital, I'll call it the fundraising markets are done, but it's much slower than all you had to do is put out a couple of emails in 20 and 21 and money was flowing your way. So it's a very different environment.
Absolutely. No, I agree with you there. So yeah, if someone was looking to raise capital in this market, what's the way to go about it? If you're moving away from just email, how do you build those relationships? How do you show people that you have credibility and that, hey, these are real deals that we're doing here?
Well, again, I don't know that there's any one way. I can say the only way I've tried to do it is creating multiple lead funnels where you're trying to attract people and be seen as a thought leader in the space. So that's having a platform on social media, posting a couple times a week or putting content out there that's valuable for people to use on an educational basis. It's being seen on your podcast, Ryan.
We're doing it here. Yeah.
Doing what we're doing here so that people know who Randy is and who Ryan is. And someday they may get an email from me and they say, oh, I remember that guy. Networking all the time, going to conferences, meetups, speaking opportunities. So you're trying to create multiple investors, because I'd say, you probably need to talk to 20 to 50 people to get one or two investors. And especially in the retail space, I call it the retail space that we work within. We're not the large family office or institutional investors yet, maybe one day. But so it's just creating multiple lead funnels and having patience and building that network over a period of time, and building the track record, one multifamily at a time.
Yeah. So I noticed, obviously our specialty is in multifamily real estate. We have a lot of experience doing that. We have tons of units. And so, there's always opportunity out there in the market. And I've noticed, and maybe you have as well, that the multifamily space has gotten a lot more crowded with, groups like Lifestyles Unlimited, Jacob, all these coaching programs funneling people in, and Bigger Pockets has shifted even towards multifamily. So I'm curious your opinion. Do you feel like the space has also gotten crowded? And I'm wondering, where do you see opportunity if somebody does want to invest in real estate? Is single family still good? Is it multifamily? Is it, retail strip centers, commercial, warehouse? Like, where is there opportunity out there? And, is there effort in just sticking to your lane or seeing where there is something better?
Wow, that's an awful lot to unpack. But great question. The space has definitely become crowded. Especially in the 10 years I've been doing it, the space has become very crowded. And I would say, from my old business perspective in corporate America, it's a very fragmented market. There's mom and pop shops out there, and there's boutique shops like myself and you. And then there's the large institutional players out there that are REITs and buying large multifamily. So it's just a very and I think there's a very fragmented industry, and there's always room for another one, because everybody seems to specialize in something. So a lot of people starting out want to do a 10 or 20 or a 5-plex. They feel comfortable there to learn the game and learn the ins and outs. And that's great. And then there's people that want to jump right into, a 200 or 300 and be part of a big team. So there's there's always space for another one. I just think it depends on your expectations. I think some of the educational arms are pumping people with information to get rich quick in 3 to 5 years. And, there's all kinds of slogans out there. And I've always used the illustration of the hare and the tortoise. Slow and steady wins the race in my mind. I want to be around in another 10 years still doing this and being successful versus somebody that was, has a mindset of get rich quick. And I think that's a sad part. I think there's going to be a shakeout here in the next couple of years too, where there's a lot of deals that go south and people end up getting a tarnished name from them. Some of the big groups. That doesn't mean just because a deal has problems that the person is necessarily bad. It was when I first got started, but today I can name you great sponsorship groups that I know of that have had to have capital calls or give stuff back to the bank just because of it's over leveraged. It's nothing because of the operations, but So I think that's a subject of another whole podcast sometime. But it has definitely grown. There's still space in there. I still am personally, I'm committed. I probably have 35+% of my net worth in various multifamily opportunities around the country.
Mm-hmm.
So I just think that because of the forced appreciation, the favorable tax flow, and the positive cash flow,
mm-hmm. Yeah,
it's a great asset class.
Well, and I have to agree with you there. I mean,
I'm sorry, and everybody's got to have a place to live. That's I mean, it's obvious, but I was just listening to the Real Estate Guys podcast. You know, anywhere from 2 to 8 million unit shortage across America.
Mm-hmm.
You may not need a strip center or an office building or an industrial warehouse, but everybody needs a place to live. And until that changes, it isn't gonna get any less attractive.
You know, you brought up a good point. You had mentioned that you have about 35% of your net worth in real estate. You know, so it sounds like you're pretty well diversified. You know, you've got, sounds like, some stocks and some other types of investment, and you've got real estate. You know, I'm on the other side where, you know, I had some stocks and I had mutual funds and I sold all of those so I could be 100% in real estate. Now I have some liquidity. Obviously, you have to have liquidity when you're running a business, right, and when you're investing, and you just never know when you're going to have a need for capital. But you know, outside of that, I'd say, 70, 80% of my net worth is in, the equity of these deals, because at least for me, it's what I know best. And I know that I can perform pretty well, and I can have control over the investments that I'm in charge of, instead of trusting, a faceless company to run it better than I can. So that's kind of my reason for why I do real estate. And that's why I feel confidence about putting any deal that's out there and saying, hey, I have my money in this, and I have my whole reputation and career on the line when we do one of these deals. So if it's good enough for me, hopefully that's good enough for you. But I'm curious if you want to elaborate on, what's your thought on diversification for someone looking to invest in real estate, or how focused should they be?
Well, yes, and yes. And the illustration I gave is I used to work for, I talked to several people that are very high net worth individuals. And that the only thing they've got is their money in their primary principal residence. And I tell them my previous employer, who had a 1.5 billion, that's with a B, endowment, started out. I used to talk to the chief investment advisor all the time, and when I started there 10 years ago, they had the classic portfolio allocation of stocks and bonds and foreign, international, large cap, small cap, blah blah blah. But over a period of time, fast forward to today, they have 4 asset classes. They have stocks, bonds, alternative investments, and real estate. So real estate has become a single line item in a huge portfolio allocation. And I don't think that's just peculiar to them. I think it's in all the big money players. And anywhere between 8 to 12% of their net worth of that portfolio, of the 1.5, any place between 8 and 12% of the 1.5 was in real estate. So that was a confirmation for me that, no matter where you're at, you should have real estate in your portfolio. You're weighted 70, 80%. I'm 35, 40% and growing. I just had stuff tied up in corporate world that I couldn't get out of right away. Mm-hmm. So there's back to where we started. More people should be looking at this asset class for protection, hedge of inflation. There are downsides to it, as we talked about, but there are many, many upsides to it. And it's a great asset class, and people should really be considering it for their portfolio.
So I'm kind of wondering if you're either opportunistic or, one niche really well. If somebody had taken all their net worth and put it into real estate in 2020, they'd be sitting really good right now. And then if, they're like, well, real estate might come down a little bit, maybe I should shift that somewhere else. I mean, should someone kind of play the game of let's move around and see where the opportunity is? Or is it a better play to just say, hey, let me just stay, evenly put across the board and just let the markets do what they do?
Yeah. I think if people are brilliant and really smart and are, the answer to that question is that's market timing versus a buy and hold position. So, the market timers never win, at least in my mind. I'm not smart enough to be a market timer in terms of which asset classes are going to be rising and falling. I listen to the pundits like you do as to what, whether it's gold or crypto or foreign equities or whatever. But I'm just not that smart. So I personally subscribe to the theory to become a master of one asset class before you So I've been in multifamily for, like I said, 10 years. About 2 years ago, I started to branch out into self-storage. I thought I might want to be an operator there, but quickly realized I don't want to be an operator. So I stuck some money in a self-storage fund just to get a little diversification. And I think that's a good play, another asset class. But I primarily focus on multifamily and will for the foreseeable future until some macroeconomics makes me move away from
it. I hear you. So, we kind of touched on the difficulties that we're seeing in the market right now, how things have changed, and how there might be turbulent times for even good sponsors in the coming year with what's going on with adjustable interest rates. And so I'm curious if you can comment a little bit on that. Let's say there's a good sponsorship team that's run into difficulties. As a sponsor, what's your role in communicating those difficulties to all the investors? And as a limited partner, what should you expect the sponsor to be doing when they do come across difficult times? And when is a capital call the right thing? When are there other options? I'd love your opinion on all that.
Ryan, you asked some difficult questions.
This is the war room.
It's the war room. I'll tell you what investors should be very leery of, very leery of, is a sponsorship group that goes radio silence during bad times.
Mm-hmm.
So, and I've been on the receiving end of that a couple of times as a limited partner when challenges, headwinds, bad things, whatever you want to call it, happen, and the sponsorship group goes radio silent and doesn't want to communicate. I mean, that's the time when people should be doubling down in sponsorship groups on communication and telling the investors, projecting what's coming. We may not know all the answers, but here's what we're looking at. For anybody that bought a deal, I said in 2021 or 22, they bought it in variable rate, most likely. And they have had or are going to be having more challenges as that first 3-year cycle comes to an end. And either extending that variable rate note, refinancing, or selling it. It's doubtful that any of them can really sell it at the type of pro forma they projected right now. So I think the limited partner has to hear from the general partnership team is, what are our options on that? Can we sell? Can we extend? Can we refinance? And then talk about the pros and cons of each of those and what the sponsorship group is doing or recommending. We're going to refinance this to bring the interest rate down. It's cash flowing. We'll meet all the covenant agreements. It's great. We're refinancing. It's not a capital call. We have a capital call because we have to extend the loan, and we want to ride it out. So we need to have the buy rate cap insurance. Properties performing. I think the worst case is those properties that are not performing, not meeting the debt covenant agreements from the lender, and the capital call is just to stay alive. And those are much harder to sell to limited partners today, and rightfully so. But I think the limited partner also has to think about what their objectives are and how much they believe in the sponsorship group, because in those situations, there's a risk of potentially losing your equity investment, all of it, if in the absolute worst case scenario. So I think the short answer or summary is that what's the reasons for a capital call? And the limited partner understanding those reasons for the capital call, very detailed, and having comfort with them.
Absolutely. Yeah. No, I mean, I agree. More communication is always better, especially when there's turbulent times. I mean, I've learned that lesson myself doing all forms of real estate, that the times that I had a difficulty in trying to get the communication across because it wasn't the best, it just, once I got it out there, we were able to deal with it and handle it, and everyone was above board. So I've always lived that way.
And the worst thing you want is to surprise an investor. Surprise, Mr. Investor, we're having a capital call. We need your money within 35 days, or you're going to be diluted, or you're going to, that's the absolute worst thing. And regrettably, there's probably a lot of that going on right now.
I gotcha. Well, anyways, I know it's been kind of more on the war room theme of, hey, what are some of the difficulties? Obviously, it's a tough year for investing, but we are all in real estate because we want to become financially free. So let's talk about some of the lighter side of, hey, tell us about the journey of, like, how has this real estate journey made you financially free, and what are the potentials for people looking to have that happen to them?
Yeah, I didn't get into necessarily be financially free. I don't want to be Donald Trump. I don't want to be myself. This is just my business model. I don't want to build a large company with 30 employees or 50 employees. I did that in the corporate world. I'm just in the season of my life. I want to focus on really what I think are quality deals, good deals with good people and good experiences, and invest in deals. And that, back to me, it's slow and steady. So over 10 years, I made 130% of my money. I hope I can do that in the next 10 years. So, if you look at that over a 20-year period, that's real money. Whether you invested 10,000 or 2 million, that's really nice return. And so I think it's the old compounded interest one. Buy one deal, get in it, learn it, educate yourself, learn about the people. 3-5 years, hopefully it sells, makes profit. You turn that and you invest it into 2 deals. Hold it another 3 or 5 years, and maybe get so 1 becomes 2, 2 becomes 4, 4 becomes 8, etc. And that's the miracle of compounded interest, of compounding. So I myself have seen a lot of groups that want to go really fast and go big, are struggling now. And I think those are the ones that I would be cautious of, unless they've really built a back house operations. And I've seen other ones that have gone very fast and big that have been very successful because they've got large backing, equity backers, large infrastructure behind them of people, investment and relations people, underwriters, property managers. They're vertically integrated. They're vertically integrated. And so that also is a key element of I think in today's environment, the really big ones are vertically integrated. And that's not bad. It's not good. It's just depends on what your business model wants to be. So
yeah,
if that LP investor just wants to get into the market, dip their toes in, do it. Find a good sponsor and go from there. And I encourage my coaching students to develop a strategy. What's your investment strategy?
Absolutely.
Put it on paper. And put it on paper so you remind yourself that when you see a deal from Duluth, South Dakota, that you're going to, no, thank you. Or maybe that's a great market. I don't know. It's not where I'm focusing though. So that's not part of my investment thesis.
Yeah. Well, I'm curious, with everything that we've been talking about, what's gone on in the past, what we predict for the future. I mean, other than, these kind of predictions, what has your attention these days? What are some of the ideas and thoughts that you're focusing on in your real estate journey right now?
Yeah. 23 was the year of transition. It was a good year. I only bought one asset in 23, and it was towards the tail end because it was just such a good asset. I'm focused on continuing to build some of that infrastructure, as we talked about, when deals are slower. I think the investor database and my branding and the business opportunities in the background, trying to expand the coaching business. That's what I've talked to John about. He's a great mentor there and leader in that space. And he's got some great ideas. And there's that aspect of it to it, but just being in the game. Continuing to be in the game and for the long haul. And I'm confident that, with the rise in interest rates, I've simply heard is that rise in interest rates, development has become very difficult. It's not stopped entirely, but it's slowed down immensely. And so in 23, 24, we're not going to start building again until 25 or 26. So that supply versus demand issue is going to continue to compound with the shortage of units across America. So I think the best advice I've heard is expect 24 to be a flat year, but 25 and 26 to be growth years when the market starts to rebound and there's been a shortage of buildings and there's a continued shortage of space for people to rent. So I'm optimistic, I guess, is the short answer, Ryan, for just staying in the game and continuing to build your space.
Yeah. And, I see that a lot myself. I mean, I heard construction starts, at least in Austin, are down like 80%, which it makes sense, right? When interest rates are 3%, yeah, let's buy and build everything we can. And when they're 7%, hey, let's just wait until they come back down before we start building. And so, we do our deals on 5-year pro forma holds. So we say, hey, look, we're going to get our, rents up to market the first year. Maybe we won't have rent growth the first year or two. But yeah, from 25, 26 on, people are still moving to Texas. they still need places to live. Some of these buildings are 60, 70, 80 years old. It's getting tougher to renovate them, and if they're not building any new stuff, it's just going to get more expensive, or people are going to have to move out further. So I hear what you're saying, and let's just kind of keep long-term vision on these deals that we're working on.
I've heard in Houston, the average new number of units coming on in Houston, just one market I'm perfectly familiar with, 14,000 units a year, year over year, have been coming to Houston over the last. And in 23, we were down to single digits, like 6,000 or 8,000 units come online. So just that gap of, and like you said, people are continuing to move to Texas.
Yeah,
it's crazy.
Absolutely. Well, I know we're getting close to the end here, but, are there anything else, if people are looking to do investing with real estate, anything else that you kind of want to let people know about your philosophies and anything that would be important for them to know?
I think just summarize is be a long-term player. Continue to educate yourself. I mean, wherever you're at, whether you've been in this field for a year or 15 years, it's about educating yourself and continuing to build your network. So you never be a lifelong learner, and don't be analysis paralysis. Jump in the market, and I think over the long haul, you're going to be rewarded for it.
I hear you. No, I think that makes a lot of sense, and just kind of staying with it and keeping true to good work on this. So,
and that's whether you're a passive or a general partner. I mean, if you're a passive, just be picky about the deals you get in, but stay in the game.
Yeah, absolutely. Well, Randy, if people in our audience here want to get a hold of you, what's the best way to get connected or reach out?
Well, thanks again, Ryan. It's been a real pleasure to talk to you and your audience again. Easiest way to get a hold of me is there's several ways. I'm on all the social medias, LinkedIn, Randy Langenderfer. I don't know if we don't have show notes here, but we can put it out there. Randy Langenderfer on LinkedIn, Facebook. I have a web page that you can put a contact me on. It's invest-ark, A-R-K, invest-ark.com. And there's a contact me button out there. That'd love to speak with you if you want to talk about anything real estate, because that's what I do. Enjoy talking about it.
Absolutely. And do you have like a fund that people can come into, or do you think you'll have a deal coming up soon people can jump on?
I don't have anything on the immediate horizon. I am looking at starting a fund. That's one of the other initiatives for 24 for me. I'm not convinced whether deal by deal or fund is the way to go for me personally, but stay tuned. You'll be seeing it on social media, whatever the final decision is.
All right. Excellent. Well, I appreciate everyone for tuning in. Thanks so much for joining, Randy. And, this has been the Real Estate War Room Live. We'll see you guys again next week. Take care.
Thanks, Ryan.